Very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The markets are stable after what appears like a nose-diving kind of a move. We did not really build on that weakness, so we kind of bounced off. But clearly, buy on dips will get tested this time, it appears. We've had a stupendous run in the market, almost nudging just about 200 points away from the 20,000 mark. So many are calling it we've run too much. Others are saying the rally is justified. Let's see how it goes from here on. But we have Vinay Jaising of JM Financial Portfolio Management to talk more about numbers. Vinay, afternoon. Thank you so much for your time. Which side of the argument do you belong to? One are saying that the markets have run up too much in too less time. Others are saying that no, it's different this time. The perilous words are being spoken once again. This rally is justified on the back of good macro earnings and flows. How are you tilted? Which way are you tilting?
So think about it this way, right? In the last 3 months, the market's up 15%, but YTD, the market's up lesser at about 5-6%. So what it's telling us is we've started the fiscal year with a bang, but we've still underperformed, say, NASDAQ, which is up 35% in the last CYTD, as well as Japan, which is up 24%. But yes, now in the last 3 months, we are the second best performing market, coming just a little below Japan. Having said that, our macro situation is a lot more stronger than most of the other countries in the world. We've seen flows come in both domestically being very, very strong, as well as from FIIs. FITD, our flows have been almost $10-11 billion. Clearly retracting what they had done last year. Last year, they were negative $19 billion. Club that up with very good earnings results, which are coming up. We've started seeing banks, HDFC's results were great. IT results were not so bad. So we're seeing an earnings uptick as well. So I think the market is looking resilient, but now it's becoming more a stock pickers market than just betting on an absolute index. So I come in the latter category, but I would be saying, let's bet on stocks. Let's not bet on the market in totality.
Fair point. There are, even in a which appears like a richly valued market, you may find bargains, and which appears like a very depressed kind of a market in the peak of pessimism, you may find stocks which are very expensive. So it all boils down to stock picking. How are your stocks in the portfolio performing? Not in terms of stock market performance, but in terms of earnings. What kind of earnings outlook are they offering? On a blended basis, are you still witnessing 25% plus kind of earnings for your portfolio?
So overall earnings growth is in the 20 to 25% band, which what we're expecting in the next 2 years in our overall portfolio construct. But that's divided into the capex sectors where the earnings growth are 30 to 35%. And then, the banks, which in the short term are going to give you very strong earnings results, which this quarter itself would be between 30 and 50%, but would then taper down to somewhere close to 15% in the next year. And then finally, some stalwarts, which we are taking at about 15% earnings growth. So the mix would be about 20 to 25%.
Fair point. Vinay, what is the one call at your place that you guys are taking very different from the rest, a contra kind of a call? Because, that's where perhaps the probability of very high degree of delta would exist.
We are taking a disproportionately high bet versus the index on the industrial and the capex segment. Wherever we are seeing an order book north of 4 times, be it in water treatment, be it in defense, be it in cap goods equipment, where the order book is north of 4 times, and we're seeing very good visibility for it to increase further because we're seeing the India capex move out, and the stock is at a PE of sub 20 to 25 times and a ROAS of 20% even for F25. Those are the spaces we are buying, as much as 15% weightage, where the market would be as much as 6 to 7%. So that's the single biggest place where we are taking large bets.
Are you incrementally starting to study IT in more greater detail, especially the mid-cap end of the market? Because, it appears that the market is not ready to listen to the commentary coming in or even paying heed to the results which some of the IT companies are posting and are moving ahead. Could worse be priced in there?
So, we are underweight IT, but we've increased our position in our underweight stance by buying a small cap company. The reason we did that was we think most of the bad news is getting priced in sooner, but we were quite surprised seeing the rally in IT in the last month, which was really very fast. It was more like a dead cat bounce rally for everything moving on. If you look at the results which have come out, flat QOQ numbers, 6 to 8%, depending on the company we're talking about on a year-on-year basis. Challenges at the EBITDA margin, and they're also talking about one more quarter of pain before they can really give you the revenue growth numbers come in. Interestingly, also, Infosys results are not yet out, and you've seen 4 other IT numbers come in. So we're eagerly awaiting the Infosys results, more so not the results, but the commentary. But our bet is, we were grossly underweight IT till a month ago. We are inching up, being somewhere between underweight, but reducing our positions to about 70% of the overall category of the weightage which the IT sector has, and buying small caps.
Follow up on financials. You have large financials, private sector financials in your portfolio, and incidentally, we are having this chat when the market is looking forward to birth of another big behemoth financial services company. Right now, maybe a lakh crore and MCAP at birth itself without any business model yet on the table. So one of the biggest startup being born. But of course, nobody can question the legacy of that conglomerate in execution. Have you studied that? Are you starting to look at prospects of Jio Financials just as a business? I'm not talking about the stock. Would you look at it?
So a couple of things. Your first part of it, how we're looking at financials, we think the loan book growth of 15-16% is here to stay. Hence, we like the big private banks, the biggest bank, HDFC, results which it showed, order book growth of 16%, and very interestingly, bottom line growth of 30%. I repeat, 30% on a year-on-year basis, 2.5 times book. Make us look, a little less further, because, that is clearly one of our favorites to buy. You club that up with companies like Karur Vyasa, Fed Bank, wherein order book where the loan book growth has been 16 to 18% or higher, and the PAT growth has been into 2x and at sub 1 times price to book. So we have a lot of exciting names, but more so in the banks. Where we are underweight in the financial space is in the non-lending business or NBFC plus, be it insurance or AMC business. That's where we are underweight overall, and we think that's where Jio would be playing a much bigger role, wherein it can showcase its connectivity to the end consumer. In a way, you're looking at Bajaj Finance being born again, but with more connectivity is coming in from a tech angle. So it's clearly a reason to be concerned about. We also are awaiting the business model for this thing, but what we're doing for now is we're being away from the new age companies linked to fintech.
That's a very balanced approach. Have you guys valued it yet? They're talking about 150 to 200 rupees a share initial value. Have you looked at it?
So clearly, we want more financials before we can make a logical comment on this valuation for Jio.
Vinay, let's talk about pharma, because that also seemed to be giving early signals that the worst of regulatory and pricing pressures in the US may be coming to an end, while the domestic pharma story is only beginning to look even better, because now people are calling it a longevity story, over the counter, good growth, and a variety of products. Any side of the spectrum you like in pharma?
So firstly, we are bearish the dollar. We think the India's rupee is here to strengthen courtesy where commodity prices are. We can see that in our current account deficit, which is virtually minus 0.2 in the last quarter. And we think based on where we've tied up with Russia on crude, we won't be surprised if our forex reserves go from 595, 600 billion to as much as 650 billion. So we are not looking at those pharma companies which have global exports being a big number in their overall perspective. We're looking at domestic behemoths. Having said that, also in the pharma sector, we are looking at companies in mid cap and small cap, which are producers of raw material, companies like AMI, which are producers of raw material to the next gen, which is API, which then gives it to the formulators. So that's where we are placing our bets on. Valuations for these companies are at 25, 30 times, but the earnings growth is very high at 25 to 30%, and the ROCs are also north of 25. So we're looking at the pharma space more at the manufacturing level, where you have contract manufacturing contracts given, and at the other end, the big domestic export company. These are the two spaces we are looking at in the pharma space. We are not looking at global exposure.
All right, Vinay, thanks for chatting. Always good to have you on the show. Time for a
Thank you.
short break there on the channel. Once we come back, we'll get you some more big movers and shakers and what are the story which are driving those moves.